Welcome to the Thomson Reuters Idea of the Week and Alpha Now. I'm John Cozy. In our December StarMine U.S. sector outlook, the financial sector had the widest disagreement between growth forecasts and current market pricing. That could mean opportunity for those with better forecasting skills. We looked into two popular banking ETFs, the SPDR banks and SPDR regional banks, using StarMine modeling. Here's what we found. First, the bad news. StarMine's three credit default models scored 35 of the 89 banks in the bottom 20% of all U.S. companies in one or more rankings. The low scores were most noticeable among the top market caps, including Big Four names Wells Fargo, JP Morgan Chase, Bank of America, and Citigroup. The Smart Ratio's credit risk models show lower component scores in areas like those shown here for Bank of America in profitability, leverage, and stability of return on equity. Bank stocks overall have high StarMine value momentum scores. The scores combine the momentum models for analyst revisions and for price movement, as well as the two mean reversion models for relative and intrinsic valuation. One name without low credit default scores, but with a high Valmo score of 93 out of 100 is Fifth Third Bancorp. It also scores a high 91 in the Smart Holdings model. Smart Holdings assesses 25 factors that fund managers use to build their purchasing profiles, including return on equity and assets, earnings, and revenue growth. The goal is to project which stocks they're likely to buy in the next 90 days. Fifth Third is one of those banking names with a wide gap between its 5-year earnings growth forecast that StarMine calculates and what the current market price is implying about that growth. Another area with noticeably lower scores was in the short interest model. The bottom 20% short interest scores came in smaller market caps, under $2.5 billion, in 22 of 23 cases. Now here are some names with decent credit scores, one or more StarMine model ranks in the top 20% of all U.S. companies, plus a wider than average spread between analysts' 5-year earnings growth forecasts and how the market seems to be pricing their shares. In the large cap space, $20 billion in market cap BB&T Corp holds top 20% ranks in StarMine's relative value, intrinsic valuation, and short interest models. Plus, it's got a 14% 5-year analyst compound EPS growth rate and a market implied growth of only 4%. In the mid-cap group, $5.3 billion market cap Huntington Bank shares shows top 20% scores in 4 model categories: value momentum, relative valuation, smart holdings, and earnings quality. As with BB&T, there's a big percentage point spread between its 5-year EPS growth forecast and its market implied growth. And finally, in the small cap space, there's $1 billion in market cap Chicago-based MB Financial. The company scores well in value momentum, analyst revisions, and intrinsic valuation, with 5-year analyst compound EPS estimates of 35% and market implied growth of almost 23%. Thanks for watching. I'm John Cozy.